So this drill baby drill thing is just it's pure garbage. Okay, the United States is producing more oil today under Biden, who everybody in my industry thinks is like the most negative for the oil and gas industry of any president in history. And yet United States oil and gas production's at record high, which kind of goes back to my point that the president and party don't really have very much effect on that. Now, credit markets do. And the reason the president doesn't have much effect on that is that we have an almost fully privatized oil and gas system. We don't have a national oil company. Anybody in the world can go out and buy a lease.
Guys, welcome to Capital Cosm. Today's guest is the one and only Art Berman, top oil expert and geologist. Art, I'm so thrilled to have you on.
Danny, it's really nice to be back. Hope everything's going well with you.
Yeah. We've been growing the channel substantially since the last time we spoke. And lots of things to talk about, especially as it relates to the energy markets as a whole. So let's just start it off with that. Art, what is occupying your headspace right now? What is top of mind for you as it relates to the energy market, the markets in general, anything geopolitically? What's front and center for Art Berman?
All of those things, they're all related. And energy is the organizing principle, I believe, that links or weaves together all of the subjects that you just talked about, and that includes money and investing and all sorts of things. Which is not to say that the price of oil dictates how all those other markets behave, but at the underneath it all, the substrate, so to speak, it's always energy. And that shouldn't be hugely surprising, but we can get into that if you like. So what I spend most of my time trying to understand are where we are with the financial system as it relates to energy, how geopolitics is affecting one way or another those fundamental balance points that relate the two, where the factors that affect complexity, the way that our society has become so complex that something that happens in the Red Sea has effects that travel all around the world. And the other subject that I always like to pay attention to is just where we are with respect to governance and the way that people view their relationship and their trust or lack of trust with government and institutions. And so when you take those four factors, and I believe that those are the biggest risks to tomorrow, today, but certainly for the rest of this decade. And that's not to say that I don't believe that things like climate change or peak oil or whatever, those are all important, absolutely critical, but they happen in sort of a longer time horizon. So whatever happens, let's just say with climate change, the fundamentals of where we aren't going to change in the next 6 months, nor is society liable to collapse because of it. Now I say that, and somebody will probably find a special case, but generally speaking, I think that's true. Whereas, for instance, if some geopolitical event occurred, let's just say, the things got really weird in the Persian Gulf, and for some reason the transit through the Straits of Hormuz was disrupted or slowed, that would have an effect on every single thing we do tomorrow. Okay, so it's I'm not in any way putting value judgments on any of these factors or risks. I'm just trying to prioritize them in terms of how immediate, intermediate, or longer term their effects might be. So those are the things I think about, and obviously the big thing that's been going on in oil markets certainly has been the ongoing conflicts in the Middle East, not to mention what's also been ongoing in Ukraine and elsewhere in the world. And so we've recently, I mean, just in the last week, kind of adjusted to temporarily the exchange of attacks between Israel and Iran. And so when all that was going on, oil markets were very nervous. Prices went up a little bit, as a risk premium was built into the price. And now that, at least for the time being, that is over, oil prices have, they dropped the most in 2 years on Monday. So that was kind of I mean, that doesn't change my life, but that's what oil markets are looking at. And now that that issue has subsided a little bit, traders and analysts have kind of returned their focus to, well, yeah, but what's the macro picture? What's happening in China? Is OPEC really going to go ahead with increasing their production as scheduled next month? Or are they, today they're saying there's, I don't know, call them well-founded rumors or information from unidentified sources that perhaps that'll be delayed, and that shouldn't surprise anybody. So those are kind of the front and center issues that are on my mind. There are many, many others, but those are the things that are most affecting oil markets. And of course, all of that bleeds over to some extent into natural gas, at least the international, the liquefied natural gas part. And then, of course, we have an election coming up a week from yesterday, and a lot of people think that the visions of the future of these two candidates, I think, as Kamala Harris says, are very different, and I would certainly agree with that. And their rhetoric on energy is also quite different, although I'm not particularly convinced, first, that either of them knows very much at all about energy, and second, that whoever is president makes all that much difference. But those are topics we can discuss as we go on, if you like.
Yeah, let's just take it from the top. You did mention the danger there in the Red Sea with what could potentially be a Straits of Hormuz closure should this escalation continue between Israel and Iran. What happens if Iran does close the Straits of Hormuz, and or their oil facilities get struck? What
Right.
happens to the oil market then? What are the consequences to the oil price? How do you kind of forecast that out?
Well, the simple answer is no one knows. So, just to be perfectly frank about it, but and let me say first and foremost that I strongly doubt that the Strait of Hormuz will be closed.
Mm.
It never has been, let's put it that way. There have been many, many conflicts in the Persian Gulf, and of course, that strait separates the Persian Gulf, from which Saudi Arabia and Kuwait and Arab Emirates and Iraq and Iran all produce a tremendous volume of the world's oil. And that strait, of course, then leads out. I mean, tankers have to pass through that strait to get to the open ocean and take their cargoes whichever direction that they need to from there. So I think the probability of the Strait of Hormuz being closed now or in the future is very low. That doesn't mean that it couldn't happen. And the reason that I don't think it'll happen is, um, everybody loses. I
Mm.
mean, Iran would have to be the one that initiated that, and that would cut off their ability to export oil. And Oil is one of the primary revenue streams to keep that country prosperous or reasonably prosperous, and for their government to fund, not least importantly, its military and other activities. So, it's hard for me to really understand why they would do that. Second question is, can they do that? I mean, the U.S. has got, a pretty big fleet permanently in that area. And so I don't think Iran wants to get into a war with the United States, and the United States doesn't want to get into a war with Iran. And so, what exactly would be the mechanics of closing the Strait of Hormuz? Um, and there are other players, obviously, like all the other countries that I mentioned in that area, all of which have different kinds of relationships, not only to one another, but to the United States and to Iran. And so, yeah, I think that's a low probability event, but it's certainly something to keep in mind. It's possible. I think I like to think of things probabilistically, and, to be I guess, as pessimistic as I could possibly be. I would say there's probably no more than a 20% chance that that would happen. And realistically, I think it's in the 1 to 5 chance. Now, as soon as I say that, it'll probably happen. But, uh, you know, based on, I mean, a lot of which I just explained in simplistic terms, I just don't think that's going to happen. But it is important to say that Iran exports, somewhere 1 to 2 million barrels a day. Most of that goes to China, at least right now. And that's a factor too, because I mean, everything is connected and interrelated. And so, how would China react to having its oil supply cut off? Well, not very well. China, unfortunately for China, is a pretty they're the world's largest importer of oil, and they get an awful lot of it from Iran and Russia and some of the countries that are not particular friends or allies of the United States. And so in the diplomatic, or the geopolitical realm, everybody has to be mindful of trying to balance all of the major players or powers in the world, their needs and their requirements. We don't want to get into, and we, the United States, don't want to get into any kind of a intensifying stress situation beyond what we already are with China. Certainly don't want to get into a military conflict. Neither does China. So, all of these things end up having an effect on all of the actors that are involved. And that tends generally, hopefully, to keep the volume at a relatively low level. Having said that, I, I don't I don't think that things are over by any means between Iran and Israel. And I expect, and I think most market analysts expect, that um, Israel's not done. They went into Iran. They did some things. Nobody's really 100% sure what was done, even. Whatever happened, I don't believe it's the end. What happens next? No one knows. A lot of that depends on what Iran does next. So it's to say that it's complex is an understatement, right?
Yeah, definitely. And it appears that the oil market kind of shares your sentiment. There has been that risk premium that's essentially been wiped out over the weekend, or ever
Mm-hmm.
since the weekend. Oil's down to $67 versus the low 70s that it was trading at late last week. My question to you is, to the average energy investor, this seems kind of counterintuitive. You have
Yeah,
all of this potential energy seemingly all over the world,
right.
between Israel and Iran, between Ukraine and Russia, and yet the oil price is unfazed. Number one, why is that? And number two, what is the reliability of the oil market in general? in price and accurately pricing in these geopolitical events?
Sure. No, those are important questions. So oil, like most markets, has a price discovery mechanism, and traders are the main mover in that price discovery mechanism. And so something happens, or we think something's going to happen, and that creates a kind of an arbitrage in which some people think the price is going to go up and other people think the price is going to go down, and some people don't think it's going to change at all. And so there are trades that are arranged based on those differing opinions. And so traders, professional traders, will follow the trend as far as it goes. Let's just say it's up because there's concern about disruption of some sort. Tensions are building until it can't find someone to take the other side of the trade. And then it stalls out and maybe goes in the other direction. So the market is using a tried and true, but kind of a trial and error approach to try to understand what structural changes might occur as a result of whatever the stress factor is. And so the kinds of things that factor into this are, well, there hasn't been any disruption of oil supply for pretty much forever. Coming out of Iran, let's just say since the Iran-Iraq War, which was in the early 1980s, that was a big disruption. Of course, it had nothing to do with Israel or any of the players right now. Iran and Iraq are, they're almost the same country in some ways right now. Iraq is essentially a kind of an unofficial vassal state of Iran, and we can thank our brilliant neocon foreign policy ignoramuses back under George W. Bush for creating that situation. And that's not a political statement, but by the U.S. choosing to attack Iraq and occupy Iraq, we completely upset the balance of power in that area. And that worked hugely in favor of Iran, I'm sorry.
Mm-hmm.
And most of the power that Iran has right now is thanks to those very poorly considered moves that the George Bush administration made during that period in the early
The
2000s.
unintended
Now,
consequences.
well, you can say unintended, but anybody who understood the focus of U.S. or preceding British foreign policy in the Middle East would have, and in fact did say, this is stupid. This is really a bad thing to do. Now, I'm not, arguing the morality of it. Certainly, Saddam Hussein in Iraq was, not a good guy, but nonetheless, he his regime, while stable, was a buffer against the expansion of Iranian power. And as soon as he was gone and the US was in there, everything reshuffled. And nobody particularly, I mean, nobody in the Middle East liked having the United States as an occupying force. And that brought a lot of other actors onto Iran's side. That's when they started funding Hezbollah and Hamas and all of these other proxy groups elsewhere in the Middle East, and they were able to do that because of all the money that they were getting from their oil sales. And we had created another imbalance that helped that out. So that was eh, I don't know that George W. Bush would ever say this, but I think that most historians acknowledge that that was one of the biggest errors that has ever been made in United States foreign policy, for all the other, you know, reasons that we might have thought then, or even might think now, that, well, it did have, there were reasons for it. And I'm not arguing those. I'm just telling you this was not only the effect, but it was a predictable effect, is what I'm
Mm,
saying. And so, without trying to get too far off the thread of your question, it does it does bear on the election that we're about to enter into. And I would say that, and again, this is not a political statement, but I think it's based on experience. It seems to me that Donald Trump is at least as ignorant of foreign policy as George W. Bush was. It's not because he's a stupid man. Foreign policy takes a lot of study and attention, and for whatever positives people see in Donald Trump, attention span is not one of them, and it takes a lot of focus and study to understand all of the moving parts. And so and who knows, I mean, what Trump says publicly and what he actually plans to do, are undoubtedly two different things. But I mean, a lot of what he did when he was president the first time in the Middle East was pretty close to as silly and without regard to the way foreign policy had been done as what George Bush did. This idea of just nullifying a treaty against Iran, with Iran. I mean, and we can 100% agree that maybe that was a bad deal, and maybe it shouldn't have been done. But to just walk away from it, that's not really a very prudent thing to do. And of course, it caused prices to go up hugely. I mean, the last price rally that affected everybody before Ukraine was in 2018, following Trump's unilateral decision that, okay, we're not only going to walk away from this Iran nuclear deal, but we're going to put a full press, oil sanctions on this country. And that just threw the whole oil market and subsequently the financial market into a fair level of chaos. So those are just some thoughts and observations on what's going on. But back to where we were, price discovery and how markets think, if markets can think. What traders know is that, well, what I think you and I know, markets are really, really good at optimizing profit in the short term. That's what they do. That's what they do extraordinarily well. Markets are really not.
they're very high time preference.
Very, very well said. Yes. And so markets don't place much value on things that might happen, particularly if the might happen time horizon is 6 months or a year from now. Markets, I mean, and so for instance, in an oil market, traders might start working with options. Okay, because that way they don't have to put down as much money. The trade doesn't cost them as much. And so maybe I'll take out an option on oil going up 10 or 15 or $20 out, whatever time period you want. But the volume of those kind of trades is relatively small compared to the overall momentum of the market. And in fact, if you look at the volumes that are placed on monthly oil contracts, the futures, so to speak, not so to speak, that's what they are. I mean, the all of the liquidity is in the first 4 to 6 months. I mean, everything that happens on a futures curve out more than 6 months is pretty much got, it doesn't have any. There's no substance to it except, there'll be Like, okay, we know that a year from now in January, oil prices will be higher than they are now because they always are. So, there will be a higher volume during, peak usage months or in the northern hemisphere summer. But still all of the money, all the liquidity is stacked in the first couple of months. So markets just tend to be very focused on the short term. And historically, whenever traders or investors have made long bets on oil prices based on sort of macro considerations like, what if this thing in the Middle East turns into a big war, they lose. And so there's sort of a probabilistic risking discount that goes into that. And of course, all that can change on a dime. I mean, obviously, if Israel attacks oil facilities tomorrow, the price of oil is going to go up a lot. Markets have that flexibility. Your other question, though, as I remember, was, well, what if Israel does attack oil infrastructure? And incidentally, one of the things that we think we know is that, or I think I know, is that among the targets that are still vague during the attacks on Iran last week were defense systems that were essentially protecting oil infrastructure in three different parts of the country. And so, if we can believe the Israeli press for right now, those areas are largely vulnerable to attacks. I don't know if that's true, but that's, there's a reasonable chance that some part of that story is true, which tells me that Israel has contingency plans, at least, to attack something. Now, the piece of Iran that's most critical is an area called Karg Island, which is an island in the Persian Gulf, and that's the loading center. That's where all the oil goes for export. So all the tankers pull up to Karg, and that's where they load their oil. And there's about 20 million barrels of storage also on Karg. And I doubt that Israel would attack that terminal because that would be, you know, similar to closing the Straits of Hormuz. It would only affect Iran's exports, but I mean that would be a very, I mean that would basically be an act of war. Not that sending fighter jets into Iran and bombing sub targets isn't an act of war either, but that would be a big deal. It's possible. I think it's unlikely. Israel might attack refineries. That wouldn't have an immediate effect on oil supply, but it would eventually have some effect. But what it looks like is that's probably a low probability event also. It looks like if they attack oil, it's going to be producing fields somewhere in a couple of areas in the interior of the country, which would certainly be a blow to Iran. It would not have a very immediate effect on much of anything. Be a factor, undoubtedly. So that's the way that situation works out. Of course, Israel has no oil. It's got some gas, and all that gas is, has been hasn't been producing since the Hamas conflict. So that's sort of off the table. And that has been the case all along, that the conflicts between Israel and Hezbollah and Hamas, well, none of those countries have any oil. So I mean, it's a big deal and it's a problem, but there isn't really any oil to be disrupted.
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, But I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So, with all that said, let's get back to the video. Thanks, guys.
And that's the way the market looks at
Right.
it.
Now, you didn't mention the foreign policies between Trump and Harris. I want you to kind of expand on that. Let's
Mm-hmm.
look at both of their policies as it relates to number one, energy, and then number two, foreign policy, because foreign policy is upstream of everything essentially.
Mm-hmm.
Your foreign policy can affect your energy prices, it can affect your inflation, it can affect the world economy. So, if you can walk us through what are some of the stark differences between Kamala and Trump by way of number one, their energy policy, and number two, their foreign policy, and what do they mean for energy prices moving forward?
Yeah. So the first thing I want to put on and then take off the table is the tremendously mistaken notion that the United States could produce a whole lot more oil or gas than it does right now, if only.
Hmm.
If only we didn't have, these kinds of regulations or whatever. And that's just, I mean, I understand why people think that, but it's just absolutely untrue. Um, I don't think that either party or their majority or minority in Congress or whoever ends up being president or not president has very much effect at all on how much oil the United States produces. I remember a couple of years ago, Newt Gingrich he was a candidate. I think this was back in I can't remember 2000. Well, it was sometime. I think it was during leading up to the 2012 presidential election or something like that. And Newt Gingrich was mouthing off about how, well, if all of its production goes away, and at the time it was producing 4 million barrels a day, then the United States could just start drilling, our ass off or something in the Gulf of Mexico, and we could supply our European allies with 4 million barrels. I mean, what a bunch of nonsense. I mean, I don't know how much of that is just propaganda and how much of it is just pure ignorance. But no, the United States absolutely does not have the capability to, it's not like we have 4 million barrels a day of spare capacity sitting around that we could just turn on, nor do we have 4 million barrels a day of proved reserves that could be somehow drilled, developed, and brought on stream in any kind of a meaningful time frame. So this drill baby drill thing is just it's pure garbage. Okay, the United States is producing more oil today under Biden, who everybody in my industry thinks is like the most negative for the oil and gas industry of any president in history. And yet, United States oil and gas production's at record high, which kind of goes back to my point that the president and party don't really have very much effect on that. Now, credit markets do. And the reason the president doesn't have much effect on that is that we have an almost fully privatized oil and gas system. We don't have a national oil company. Anybody in the world can go out and buy a lease. And yes, it's true there are federal lands, and some of those are in the offshore, which the owner of those mineral rights is the United States. And so there is sort of a once removed aspect, but most of those minerals that are in prospective areas like the offshore Gulf of Mexico have already been leased to someone else. And so when the oil industry complains, oh well, there's or opponents of of conservation or the Biden administration. Again, nothing I'm saying about Biden or Trump is meant to be political. It's just how it affects energy. Um, Use it or lose it. I mean, what a preposterously absurd kind of concept that is. So if I'm an oil company, or if, I'm Art or Danny and I want to buy a lease, and it's, say, in the offshore Gulf of Mexico in 5,000 feet of water, and that lease has a 10-year term. It has a 10-year term because it's going to take me that long to shoot the seismic and do all the work and decide, figure out if, do I think there's enough stuff there that might warrant, a capital expenditure, and get around, getting a rig, which costs hundreds of thousands a day, and drill a well, which takes a long time, evaluate the results. If it's positive, spend a few $1 billion on an offshore platform and put subsea pipelines. Point is, it's going to take 10 years if it's full speed ahead to be able to do a good evaluation and get that production online. So just because I have a lease that I'm not drilling or producing on doesn't mean that, oh, well, that's an inefficient use of a lease. Look at all these acres that are under lease and nobody's doing anything. Well, that's preposterous. It's like, okay, so I own some real estate, and I haven't developed it. Well, maybe that should be taken away from me. I mean, these are basically property rights, and there's a contract in place. And so use it or lose it is just a totally ignorant concept. It just
Mm.
completely ignores the fact that people don't just throw money away. Oh, great, I got a lease. I'm going to drill a well. I'm going to spend $100 million on drilling a well. I don't know what the hell's there, but hey, I got the lease. Let's drill. Maybe we'll find. I mean, what a stupid thing. I mean, nobody's going to do that, right? So, so drill, baby, drill is just it's pure rhetoric. That's all it is. And I think people who say things like that, I hope they understand that it's pure rhetoric and nothing more. The United States is an amazing place in a lot of ways. We've been blessed with unbelievable natural resources, including oil and gas. At the same time, this is the most mature oil and gas province in the world. I mean, we've been drilling wells in the United States since 1859. And so there's very little that is unknown about how much is left. And somebody's going to raise their hand and say, yeah, well, what about shale? We didn't know about shale, and look what happened there. Well, that's not true. We absolutely did know about shale. Oil companies have been evaluating shale potential since the 1950s. It wasn't until oil prices got to the levels that they did after 2005 that oil companies had the incentive to figure out how they could make it commercial. So if we look at real dollars, 2024 dollars, in 2008, the price of oil, United States, WTI, got to $190 a barrel. Okay. It went down because of the financial crisis for a very short period of time, came back up, and from 2010 to 2014, average, and I don't remember the exact number, but I want to say it's something like $120 a barrel. So if you want to know how shale got developed, I mean, you can go gaga over the ingenuity and the technology and all this other BS. Bottom line is because we had 6 or 7 years where oil prices were super high, and it looked like they had been and were going to remain high enough for a long enough period of time that it made sense to do the investment. Same thing happened with Canadian oil sands. It's not like we didn't know they were there. We've known about them forever, and they've been developed and producing forever. But it was because of that expectation that oil prices are now high and will remain high, that the investments were justified, that you could find people to say, okay, I'm willing to make a long bet on these things because oil prices have been over $100 now for a couple of years, and it looks like they're going to stay there. And there are other people who like to say, well, zero interest rates after the financial crisis. That's why it all happened. Well, I'm not saying that, that low cost of capital was not a factor. Of course it was. But I would not say that was a primary factor. The primary factor was oil prices were super high because markets had judged that there wasn't enough oil in the world based on rising demand levels. Just that simple. Now we can, talk about all the nuances, and there were many of which, we've already gone over a few. That's the way that the market works. So the notion that the only way a president could make drill baby drill work is if he or she were somehow able to instantly make the price of oil $120.
Mm.
That would help, but that doesn't change the fact that the geology is what it is, and we are the most mature oil province on earth. I mean, you can't just say, "Oh, well, if we just drill enough, we're going to find, something that nobody imagined was there." There is a probability of that. We may find something much bigger than what we think is there, but the great likelihood is that the biggest things that are left to be found, let's just say, are, a billion barrel kind of oil field in the Gulf of Mexico. The shale plays, those are that's sort of death by a thousand cuts. I mean, okay, we've added 25 billion barrels of oil in the shale plays over the last 10 or 15 years, but they're all from wells that make 500,000, 600,000 barrels of oil. So you've had to drill 100,000 wells at $5 to $10 million a piece to get those 25 billion barrels of reserves. Now compare that to, just take an extreme, something like, Saudi Arabian field. I mean, you've got Gawar, which I don't remember the exact numbers, but let's just say for argument's sake, it's 100 billion barrels. So it's four times all the shale plays put together. And there's probably 100 wells draining that entire field. There may be less. Again, don't pin me down on the numbers. But I mean, each one of those wells makes 20 million, 30 million barrels of oil. So the economics of it are hugely different. And that's the other thing, that all of this technology has a price. It's not free. And so anybody who cares to in your audience can, go look at the Federal Reserve Bank of St. Louis. There's a measure which is called the Producer Price Index of drilling oil and gas wells. Okay, so it's indexed. You don't even
Mm.
you don't really have to think about it. And the cost of drilling an oil or gas well in the United States quadrupled thanks to the shale plays.
I see. So
Okay, so that's, and that's in real dollars. So the technology is not free.
why is it that the oil price has actually gone down in price when adjusted for inflation, however, if the extraction cost has actually gone up?
Well, because we do get more efficient, okay, that we are we are somewhat better because we drill so many wells at drilling the wells cheaper. And so what you'll see if you look at that, that chart that anybody can look at, that prices, producer prices have come down from their peak in, I don't remember when, 2014 or 15, but they're still three and a half times higher than they were in 2000, 2005. And the reason why is that before that, we were drilling vertical wells that cost $1 million or $2 million a piece. And now we're drilling horizontal wells that cost $8 to $10 million a piece. So the economics are fairly straightforward. So back to your question, is there a big difference in energy reality between these two candidates? No. Um, if you sort through the rhetoric, I would say at most, not much. The biggest difference is, at least not even on paper, in words, clearly Trump is much less favorable to renewable energy than Harris is. Okay, so that would mean or imply that there would be somewhat less money for investment, at least by virtue of new government programs for renewable energy under Trump than under Harris. But what's already in the works is there. I mean, that's not going to go away. And so that I think brings up the next question, which is, I mean, are renewables a threat to oil and gas production and investment in the United States? And obviously I mean, they have some effect, right? I mean, but renewables are by and large only good for one thing, and that's to make electricity. And electricity is 20% of global energy consumption. And in the United States, we don't make any electricity with oil. Now, some people heat their homes in the winter in the Northeast with heating oil, okay? But oil is not really part of the electricity process in the United States, nor is it very much part of the process in the developed world. There are countries like Saudi Arabia that, because they got so darn much oil, unfortunately, still use some of it to generate electricity. But that's very much outside the norm. So there isn't really a lot of direct competition between renewables and oil. Certainly not in the United States. And somebody will say, well, yeah, what about electric vehicles? I mean, all these electric cars running around, isn't that going to reduce our consumption of gasoline? And the answer is, well, sure, theoretically, but how many of those electric vehicles are there? And I'm not taking sides here. I mean, I'm all in favor of renewal. I'm all in favor of all energy. Okay, I will tell you which ones I think are a better or worse investment, but that's another part of this conversation. I mean, electric cars are like 3% of the global vehicle fleet. And maybe in developed countries like the United States, I don't know the right number, but it's in that range. In a country like China, I think they might be 8%. And China certainly got, for a relatively developed country, the biggest proportion of its fleet. So it's still a relatively small number. Now, what you hear and read in the paper is, oh my God, renewables are, 25% or 50% of new car sales. Well, sure, fair enough. But I mean, we've got 250 million cars in the United States, and new car sales is a fraction of that. Now, again, I'm not trying to cast aspersions on any of this. I'm just saying you got to look at the numbers that matter. And the numbers that matter are what percentage of the vehicle fleet are electric cars, and what are our best projections as to where that might get to, let's say in 25 or 30 years. And I know of no forecast, including the International Energy Agency, which is the most bullish on renewables, that thinks that electric vehicles are going to be more than 25% of the global vehicle fleet in 2050. And the reason for that is just it takes a long time for new technologies to penetrate. There's a cost factor. What do you do with all the perfectly good? I mean, we make cars right now that, easily last 10, 15, 20 years if you
Yeah,
take care
you
of them.
see that play out in the car manufacturing industry. A lot of these big car manufacturers have rolled back their plans of severely upgrading their fleet into an EV fleet.
Well, it's because they can't make that much money doing it. So the other part of the two candidates whose policies apparently differ is on liquefied natural gas. Okay, so Biden said, all right, we're going to pause giving new export permits for liquefied natural gas. And everybody said, oh my God, how stupid can that be? And I don't want to get into, to the sentimental aspect of that. But the truth is that if we just look at the projects that are producing, that are under construction and fully permitted, and that are fully permitted even though they're not under construction yet, I mean, we will be so far overshot in our ability to supply those facilities over the next 10 or 15 years that it'll never be used. So the real impact on LNG production and export from pausing, let's just say they canceled, that's which is not what happened, is zero in the near term. And I mean by near, I mean the next 5 or 10 years. And see, that's not generally understood. But again, you can look at a website on the Energy Information Administration, and you can find, okay, so what is the export volume of fully permitted go ahead LNG exports in the United States? And what you find is that if all of them were built, we'd be exporting something like 25 or 30 BCF of billion cubic feet of gas a day. Now, total US production is about 75. So, I mean, that's like, we're pushing 50% of US gas production to export, and we can have a conversation about whether that's even smart to do. But what I'm saying is that, this is a lot of hype, is what it is. And that's the way politics works. So I'm not criticizing it. That's just the way things are. But the reality is that it has very little effect. So that's kind of where I come down. I think the politicians in general are pretty much energy blind. They say things because it makes their constituency happy, but they don't really know very much about it, and that's because it's complex, sort of like foreign policy. It takes a lot of time and energy, and a politician goes to his staff chief and says, "Hey, give me three talking points on LNG." And he or she might say, wow, it's a really sort of a complicated deal. You got an hour to sit down and talk. No, give me three talking points right now. And of course, once he or she says that, then, that's got to be the truth for the rest of his or her term. And so that's what we're going to keep on saying. But the truth is that energy is so complex and it's so interrelated with everything else that whatever a political leader says is probably about 1% true.
Yeah, red meat for the masses. Well, hey Art,
Yep.
it's been a pleasure having you on. Anything else you want to talk about before we wrap up?
Well, we talked a little bit about peak oil before we actually
Oh
started
yeah,
recording.
do you want to pivot over to
Yeah,
that really quick?
I think we're at a point in the world where we are reaching a plateau of oil demand, and this is important. It's important for investors because that means that for a variety of reasons, we are not going to be growing our oil supply tremendously in the future. Now, that could be wrong, but all of the present facts and the change in slope of the growth up until now support the fact that, we're kind of done with the high growth period of oil supply. And what that means for the future is that if debt and credit are based on productivity, which they are, ultimately, I mean, are you capable of paying me back this loan? Let's say you run a factory. Okay, well, what's your factory run on? Well, it runs on natural gas. Okay, that's great. What if it runs on renewable energy, which has a completely different um, confidence factor? Okay, it's not dispatchable. The wind might not blow and the sun might not shine. Well, again, this is not to say anything negative about renewables. It's just that they are a lower density source of energy. And so at some point, a creditor is going to say, well, if your economy is more and more based on renewables, you're going to be less likely to be able to pay back your debt, at least in the time period that we've contracted. And so, if in fact oil is reaching a plateau, which I think it has, and will be very, very slowly declining in the future. And no, AI is not going to invent any more oil. Just like we can't print commodities, we can print money, but we can't print commodities. AI will help a couple of percent, maybe. That's it. If we even bother applying it to something as mundane as that, but that's a whole nother conversation. And so the implications for markets the implications are that we ought to be considering that growth will be slower in the future. And I believe that all of the market signals are suggesting that. Maybe that's not the explicit message. They're probably not linking it to oil or renewables, and oil and renewables are not 100% the reason, but they are certainly a potent factor. And so I think if we're looking at decreasing oil demand, and we are, for whatever reason, decreasing productivity, that says that credit markets will contract. And that has huge implications for everybody who is investing in anything, I would imagine. And is that a negative message? Well, I don't know. I think there are always, I mean, there were people that made a ton of money during the Depression, right? I mean, most people didn't, but for those who understand the mechanics and the dynamics of how market, I mean, money's not going to go away. It's just going to be put in different kinds of investments. And I think the idea that renewables is going to be where all this energy investment goes, as you've alluded to with oil car companies cutting back. I don't think. I mean that works because the government is basically guaranteeing a short-term
Mm-hmm.
profit by some tax credit or whatever, but that's not going to last forever. So those are my thoughts on peak oil that I think affect or peak plateau or peak demand. It's not. I mean, we're not running out of oil to produce, at least not in the near term. So those are my thoughts, and I think those are people should contemplate that because it's a pretty important thing. And I've written a couple of posts on that, which people can take a look at. They're all free.
Nice. Well, we appreciate you have coming on here, Art. It's very good to have a sobered discussion, sobered analysis on the energy market. Um, so if you guys enjoyed this content, remember to give us a like and subscribe to the channel if you're finding value out of these videos. Also, check out our Substack, capitalcosm.substack.com. And then finally, Art, thank you so much for coming on, and thank you guys for making it to the end of the video. And I'll catch you in the next episode. Bye, guys.
Thanks.